Hi, good morning. Good morning, FSMOne, and good morning, friends and investors out there. As I stand by just now for my turn to present the Asia two giants to you. I was looking back at my working history. In fact, 16 years ago, I was part of the leadership team to bring in the first China and India investment solutions to Malaysia. And that is way back in 2005. Not too long after that, we introduced another China Air Shares. So for the last 16 years, I've been flying in and out China, India. If you ask me what has changed, fundamentally, nothing has changed. They remain as Asia's two giants, and I continue dancing and singing with them. But one thing that has clearly changed, the stock holdings, the environment, the e-commerce, the technology, the healthcare part has changed a lot. And that's what I'm going to tell you a lot more. In Manulife, a global company, we run 3 China strategy in Malaysia and 1 India fund in Malaysia, supported by worldwide fund managers. We have been around for the last 130 years, managing 900 billion US dollars. So, the engine is, the economy engine is being switched off worldwide by all governments because of the pandemic. However, if you look at some of the stock market performance last year, if you miss that opportunity to buy at the bottom in the month of, let's say, April, May, June, July, it's a big miss. And if you miss the month of November 2020, it's another big miss because the vaccine story has came around in the month of November. However, having said that, during a lockdown situations like this, why are the equities market rallying and going new high and performing fairly well in certain countries and certain sectors? Well, the reason is simple. Because as the economy is still, not very certain. However, the capital market normally run ahead, reflecting the reopening, reflecting the recovery of this health crisis. So as governments start to switch on their engine, switching on to their recovery path, you see equities entering a new cycle. And I think the 2 countries, the biggest countries in Asia, will continue to do very well. We are very firm about this. It's not going to be one straight line recovery. It may be uneven, it may be bumpy. However, the upside is obvious. What is so obvious about the upside? Well, let me spend 1 minute and talk about this very old, 80 years old economic theory known as the Keynesian theory, all right? So many policymakers, governments, know all this, and they apply this in all crises and even in this crisis. This theory actually spoke about, number 1, increasing the money supply creates economy growth. And that's why you see, all the world's government announcing stimulus package, unprecedented amount. And that news will continue to come on. Spending is all that matters. It's very important. The most important part that you want to see increasing GDP and better GDP, and you want to pick countries, places to invest in. You want to go to a place that spending is real and taking place. Number 3 about this is price decreases is harmful to consumptions and economy growth. And that's why government has got to step in, reducing interest rate, for example. So the low for longer interest rate is going to remain with us as new norm as well. War, natural disasters, and destructions will boost economy growth. So we are at this stage right now that I think what is ahead of us is actually a new chapter for investments. Is going to be a new journey to recovery and new high. So what do we like about Asia? We like almost every part about Asia. You know, in China, you have got the 5G, you have got the biotechnology that is doing well, made in China 2025. If I move on to Hong Kong, you know, the innovations that is coming out, e-commerce, clean energy, the listed companies, you don't run any sort of Internet of Things, the consumption stock. And in Taiwan, you have got the esports that are doing very well, semiconductors, technology. Even in ASEAN, you know, ASEAN is the third most populous region after China and India as two countries. I know we actually quite like ASEAN as well for a rotation play. But, you know, let me go to India, the other biggest giant, not just within Asia, but in the world, digitalizations, their reforms, the consumptions, the technology, the pharmaceuticals are doing pretty well. And now I want to make my first point very clear to everyone, that the resumptions of growth to support the economy theory and to support today's real life is very important, that during lockdown situations like this, you want to go to a country that has got millions and billions of populations who are rich and increasingly rich, that continue to spend in their own country because they are being locked down. All right? So the consumption power and the spending pattern will drive their economy. How do I prove this point? Well, if you look at the slide, let me start with China. You know, China closed the year 2020 with about 2.3, 2.4% GDP growth. As you can see from the left-hand slide, if you look at the right-hand slide, 2021, the GDP growth estimates for China is going to lead the world. They are going to achieve something that is close to 8%. And India, not in the slide, is expected to achieve something that is like 7.9% GDP growth. So in the situations like this, it is very clear to us that if you are afraid of pandemic risk, it is quite proven in last year that these two countries has performed really well. And I think as the engines are switched on even further, these two equities market will continue to run. So let's continue with the resumptions of their growth story. The recovery momentum, if you look at the slide on your left, all right? So these are the exports, the imports, the manufacturing indicator. What you can see is a V-shaped recovery. On your right, you know, let's look at China, be it the total retail sales, online sales, car sales, delivery volume, parcel delivery volume, it has all gone back up. The first in and first out and how they will manage the COVID-19 is a good testimonial to the whole world that in fact, in China, the populations are moving around as, you know, local tourists. So even their hospitality industry has recovered by a lot. So the new Chinese VIP, what is their vision? if you look at what is their vision, within the two charts, China's contribution towards the world's and global GDP is 32%. However, they are only represented with a 5.2% in the MSCI World Index. What does that mean? That means there is a strong likelihood that in the coming future, the World Index has got to include China with a heavier weightage and more representations in the World Index. And that means people will shift and money flows and investment flows to China. So that goes into the right-hand slide on top, the inflows. The inflows into the China and Hong Kong stock markets are real. So the amount in US trillions are flowing into this stock market. And in fact, you know, China is buying Hong Kong, Hong Kong is buying China, international markets are buying China Air shares and buying Hong Kong as well. So if you look at performance, ladies and gentlemen, if you look at performance, just look at the Chonghua Index to your right-hand side. In the year of 2000 to 2010, that time that when I first launched China-India Solutions 15 years ago, the performance of China was really good, all right? You know, 2 decades ago. However, if you look at the recent 10 years, they are far more impressive. They are doing even better and greater, all right? So we can't run away from the consumption story because in lockdown, in pandemic, or regardless, even, you know, in normal days, what we really like is the Chinese consumption's upgrade is at all the time accelerating through the roof. An example, the e-commerce, the fintech, on the last November 11th, you know, their e-commerce has received another record-breaking sales. So Alibaba has done really well. If there's any questions about Alibaba, you know, 2 days ago, the share price rebounded very strongly. So, you know, a common questions about Alibaba is, you know, what is going to happen with the antitrust law? So, you know, if I can ask myself this question and answer it here for you, the Chinese government is trying to balance, all right, the monopoly, especially on the merchants. So they are trying to regulate, all right, a lot more about the e-commerce and the merchants. However, I don't think there is any intention for the Chinese government to run down their e-commerce platform. The booming e-commerce is bringing a lot of beneficiary to China. So they are not going to kill it. They are going to regulate, balance it, moderate a lot better. And in fact, as we see Alibaba share price being very stable with their own shares buyback, the smaller e-commerce player like Pinduoduo and also the JD.com will have every opportunity to do very well and catch up with someone like Alibaba, all right? So the next thing that we really like about the China consumption story, you know, even within their own billions of populations, you know, they are getting into 5G. Taiwan, you know, the semiconductors, China, data centers, Internet of Things, innovative drugs, cancer treatment, the oncology industries, biotech, their aging populations, all these, there are some stocks and beneficiary for us to invest, for the share price to appreciate. So now to just have one slide to talk about the healthcare and their biotechnology. As you can see from the slides, be it their market shares, their innovations, and their growth. They are all pointing upwards, growing rapidly, performing well in this particular sector. All right. So, if I can summarize about China right now, I'm sure you heard about the 14 5-year plan and the Made in China 2025. Just look at this particular slide alone. The one at the bottom, we know they are really good in building railways for the last decades, but it's more than just good at building railways. Now they are getting into aerospace, improving their agriculture, electrical power. They have done very well in their electrical vehicle. As we know, even Tesla has set up a plant, and that plant, the new plant, all right, not the existing one, can produce 1 million car, just to target this market and also the international market, high-end robotics, and many go on, and the list go on with many other things. So the distribution supply is going to be more self-reliant in China as well. So it's going to be less global, more digital, more control of their own supply. And that is what we see in China, and really like this country. So this will give you a lot of stocks example about their consumption. As I say, the e-commerce has done really well. You have got a lot of e-commerce stocks here as example. Tencent, Alibaba, Meituan. I know that Meituan is all over the places in terms of online delivery, food delivery, you name it, the Pinduoduo platform, and then their 5G and their 6G. CATL is producing electrical car battery, and they are doing extremely well. The Taiwan Semiconductor and the New Oriental and the China Education Group, they are doing very well on online educations. Before this, they have been performing really well. During this time, they have been performing extremely well because of online educations. The healthcare, you don't run out of stocks in terms of their healthcare, biotechnology, and even cement company, because the infrastructures are booming. They are spending a lot in infrastructures, and you can expect them to do well. Financials, be it Ping An Bank, the China Merchant Banks, Hong Kong Stock Exchange, AIA, you name it, we have got plenty of these stocks, and we have got plenty of medium to small cap stocks that you may not heard of, because our team sitting in China and Hong Kong are really specialists, and they have been winning awards as well. So just to show you our 3 funds in terms of performance. Number 1, the Manulife China Equity Fund. As you can see, in the year of 17, we have done really well, high teens. 18 was a bad year overall for the market. 19, we catch up from the lost ground, producing 21%. And year 2020, we delivered, despite pandemic, we delivered 36% positive performance. The next fund that we have, Investment Greater China Fund. Again, 2020, we have done really well. And this fund has got exposure in Taiwan. The one that I show you has got exposure to Taiwan. And if you prefer a pure Hong Kong and China fund, and this is the one by the name of Dragon Growth. As you can see, in the year of 2020, we delivered 40%. And we have delivered really well. 2017, 50%. 2019, 20%. 18 was a negative of 15%. So if you look at this fund alone, if you put in 100,000 as an example, over the last 4 years, your 100,000 could have easily given you a return of another 100,000. All right. So that is how exciting the market is. And even though people can say, oh, equity is volatile, but we love the volatility because that is how we take opportunity to make returns for our investors. So let me go into India. It's the same, all right? It's the same story. It's the same point that I've been seeing over the last 16 years. A billion overpopulations, getting richer, young populations. On your right-hand side, if you want to look at their spending, their consumption, the GDP is a good reflection, of what they have achieved. So China, India have both done really well, because they are big, they are gigantic. All right. What this slide talks about is in terms of GDP per capita. That means they are, are they rich? Are they poor? India has got a lot of upside. They have got a lot of upside, with billions of populations getting richer. They'll be spending in buying a lot more properties, a lot more cars, a lot more e-commerce, all right? And the economy is expected to grow by 3 times over the next 10 years. So let's say, if I translate this into the potential upside for the next 10 years is for your investment, to expect your investments to have an opportunity to grow by 300% for the next 10 years. That is what it means. All right. So what is the VIP for India? Just now we had it for China, the VIP. For India is, if you notice from the slide, lower export dependency, because they are so big with their domestic consumptions, and there are a lot of consumptions upgrades. They are doing very well. And you look at India, they are less dependent in terms of their exports. The one in the middle is talking about their young populations in the middle group. So these groups are growing, and they are less impacted by aging populations at this point. And last, in terms of the profits, the CAGR is 12% over the more recent year. So that explains about why we like the 2 giants, all right? They are doing very well. They don't run out of any stocks in particular that will do well, because their domestic consumption, that alone will support even more, during the lockdown, because they have got nowhere to go. They will spend a lot more in their own country's economy. So, all right, this slide is to illustrate in India, if you look at the last 10 years, 20 years, it's a lot of reforms. What do we mean by reforms? I give you a few examples. All right, in India, they get rid of the illegitimate money. They formalize the financial system. They formalize their paper money, and then they put in bankruptcy law. They put in GST, implemented the GST really well. So now in India, you have got a lot of them having e-banking, all right, tied into their handphone, their identity card, and banking. So they have got the whole ecosystem in terms of financialization. So let's look at the digital part of India, all right, the one on top. In India, they rank #1 globally in terms of tying up with what I've just mentioned, the very unique digital identity program, all right? And they rank #2 in terms of the apps downloaded, 12.3 billion. Wireless phone subscribers is 1.17 billion. Internet subscribers is 560 million. Smartphone devices, 354 million. So if you compare the size of maybe the smaller country like ours versus countries like them, you need to have huge exposure in terms of your investment portfolio to take advantage of how advanced and how fast these two countries are accelerating. So in India, they continue to invest. You know, the government recycle their money, rebuild the economy, and reinvest into their whole economy ecosystem. And that is the result. The result is India as a whole attracted a lot of FDI, attracted a lot of investment. And in terms of ease of doing business, you know, how friendly they are, how easy to do business in India, they have picked up. They have picked up and being very competitive in the world's platform. So for places like this, how can we not like them? So their country has also announced a series of interest rate cuts and announced a series of corporate tax cuts. So that attracted FDIs, that created a lot of employment opportunities. So that created less dependency for exports. So, you know, India, China may be very different, but they are two big giants that continue to do well. Some stock examples for you here. You know, in terms of consumptions, you know they have billions of populations. In terms of IT, India is well known about it. So they are also doing well in their infrastructures. So cement companies are important for us. They are also showing good results in terms of their healthcare, and their banks are extremely important as one of the pillars to support the economy. So now, going into a summary, the Manulife India Equity Fund has also performed positively well, all right, for a country and as part of your investment portfolio. From what you can see from the screen, especially year 2020, as I say, despite pandemic, they have delivered a good double-digit, mid-teens, 14% return. So I continue to see China and India to do very well for this year and beyond. All right. So my summary, ladies and gentlemen, we have got three key strategies about China. So it is about China doing really well in their research and development, be it e-commerce, be it electrical car, be it biotechnology. And we really like about China's consumptions, you know, upgrades of consumptions, domestic consumptions. China is very strong with their government policy. Their biotechs are increasingly doing well. Digitalization, you know, as we all know, they are way ahead, you know, very advanced as world player. So this particular fund is focusing in China, whereas Manulife China Equity and Manulife Investment Greater China Fund has got more exposure to Taiwan, so that, you know, you will get more semiconductors, the chips maker that participate in this, you know, upswing of the new technology world. You can't run away from chips and semiconductors. And Taiwan, you know, GDP, Taiwan's IT semiconductor companies had performed really well as well. And you know, I like about, you know, China is the other reason is because it is not like buying into one sector. Yeah, you are buying into one country, but you are buying into a very well diversified portfolio. Not one sector, but various sectors. All right. Likewise, in India, it's very well diversified. You know, India. You know, my summary. You know, the made in India, the made in China. You know, India successfully formalized their economy. Their financializations is impressive. They managed to reforms over the last 10, 20 years. You know, they are a country as recognized world high standard player now that recycle they rebuild, they reinvest, and hence they are doing extremely well. And I think these two giants will continue to dominate the world. And in terms of your investment with us, let me be very firm here one more time that I continue to see China and India equity performance to continue running, all right? To continue running. It may not be one straight line. It can be uneven over the next 1 year, 2 years, but for sure, is pointing up north. Is going to appreciate. Is going to continuously do well. It may be bumpy, but it's worthwhile. All right. Thank you. With that, I sum up my presentations.